All right, good evening. So we're going to start with this this notion of what do traders need? What do ICT traders need to understand the language to be able to communicate and learn properly? Because one of the hindrances to your learning as traders is lack of basic understanding of this ICT's concept. So in this three-part series, I would be explaining and teaching you the language in its basic sense, from the basic sense of understanding algorithmic theory, which is being taught by Michael J. Huddleston, which is the inner cycle trader. The first on our list is the market efficiency paradigm. So this set of videos will be each individual part will be at least 15 minutes long. I don't want it to be more than 15 minutes. If it's possible, it should be less than 10 minutes. All right. So whichever you get, you get. So I just only have the headings being outlined here. So we have the market efficiency paradigm. What is the market efficiency paradigm? First and foremost, you should always understand when you approach the marketplace, you should understand that it is a different paradigm from what the general public understands as a market. So this market efficiency paradigm states that for markets to be efficiently delivered, it must offer both buy side delivery and sell side delivery. How it does this is in one of two ways: going to buy side to rebalance an old imbalance, which is a CB on the buy side, or pair up liquidity with resting buy stops at an old high. Inversely, market efficiency paradigm for a sell side: for a market to be efficiently delivered, it must offer both sell side delivery and buy side delivery, meaning coming down to rebalance an old imbalance, in this case a CB, a BC, or going lower to repair up liquidity, which is resting below an old low as sell stops or sell side liquidity. That is the market efficiency paradigm. So when you understand this paradigm, it is you have done 80% of the work. Yes, I said it. 80% of the work, because you must first understand that you are in a different paradigm. And when you're in a different paradigm, you must then understand what goes on, what is permissible inside of that paradigm, what is permissible and what is not. So understanding this basic concept, it will get you towards the right place in your understanding. So to further buttress my point, I would explain the backdrop of what goes on behind the scene. Behind the scene in this market efficiency paradigm, when price goes higher to an old high, what goes on is, because there is buy side liquidity resting above those highs as pending orders, the market will become efficient for smart money traders to make use of those resting buy stops and use it as a counterparty to smart money sell orders. So smart money will use retail resting buy side liquidity and use it to pair up their sell orders. So when they're expecting price to go lower, when price trades to an old high, they will sell that old high, and then when price goes below an old low, they will buy that. What goes on is, smart money traders, the informed, let's call them the informed makes use of these orders are resting in buy side to pair up their sell orders. This makes the market efficient for them to operate in. This is how the algorithm works. This is the basic understanding, the basic idea of what the algorithm does. We already explained the idea of what it means to understand what makes a market efficient, which is offering both buy side delivery and sell side delivery in a given trading range. So the next part we have liquidity. What do you understand as by liquidity in the marketplace? Liquidity are already resting orders in the marketplace, which are presented as pending orders. But when the market trades to that, when price trades to that liquidity pool, to that pool of liquidity or an imbalance, that limit order for example, for a buy stop, generally traders place their stop losses above an old high or an old low. So when their stop loss is being placed at an old high, it will be a limit order. So the algorithm will see this limit order as willing participants to buy at a higher price. So they're already waiting to buy at a higher price when market price goes to that buy side liquidity. So that is the basic understanding of what liquidity is. Liquidity are resting orders, resting pending orders, whether as buy side liquidity or sell side liquidity. Buy side liquidity. What is buy side liquidity? Like I explained the general idea of what liquidity is. Buy side liquidity is the liquidity resting above an old high, which is above the current market price. So buy side liquidity is at the top side of the chart by at an old high, because when price drops lower, the traders will place their stop losses above those highs. And inversely, we have sell side liquidity. What is sell side liquidity? Sell side liquidity Sell side liquidity is just an inverse explanation of what buy side liquidity is. Sell side liquidity are still sell stops resting orders below an old low, because when price rallies higher and leaves an old low, the uninformed or the traders that lack the basic understanding of stop placement, we'll cover that in the third installment of this series, stop placement, because that's a lot of things traders struggle with. So because they lack the basic understanding of stop placement, so they place their stop losses below an old low, and that acts as sell side liquidity. This sell side liquidity, when the market trades to it, it is already a resting limit order. But when the market trades to it, when price trades to it, it will trigger it and it will become a market order. So the next subheading is imbalances. You must understand imbalances as ICT traders, because basically what we do is seek efficiency in the body of price action. So when a market leaves an imbalance in the marketplace, an imbalance is made up of three candles. The first candle, the second candle which the imbalance resides, and then the third candle. When the market makes an imbalance, in this instance, a fair value gap in the upside, which is a BC. When the market rallies higher and leaves that imbalance, the market only offers buy side delivery. And inside of that buy side delivery, there will be inefficient pockets of price action inside of that imbalance. And because we explained from the beginning of this video, it was explained to you that for a market to be efficiently delivered, it must offer both buy side delivery and sell side delivery. I did not say buy side liquidity and sell side liquidity. There's a difference between delivery and liquidity. All of this terminology will be further outlined in the part two of this series. So, when the market leaves a BC, an imbalance to the upside, it goes because it has offered buy side delivery at the future time in price. We're expecting price, we're expecting the market to seek sell side delivery in that trading range, inside of that imbalance, to offer both buy side and sell side to at least the midpoint of that imbalance. The how the retracement inside of that imbalance presents itself it will give you a basic understanding on what the market is trying to do next. Because, for example, when buying a BC, the best fields form above the 50% of the PDRA. So you would not want to see body closes below the equilibrium of that BC. Does that make sense? So for the imbalances, we have fair value gaps. We'll only discuss the fair value gaps in the relation to imbalances in this series, because for the PDRA matrix, the imbalances are top tier of it. Unlike the volume imbalances or the liquidity voids, those are variables, so they are not included in the liquidity in the PDRA matrix. So I hope you got something from this video. Talk to you in the next part. Goodbye and good trading.